There is something happening at the Federal Reserve right now that the financial media is completely missing. Not because it's complicated, not because it's hidden behind a wall of bureaucratic language, but because most people who call themselves financial analysts spend their time watching stock prices instead of watching the machinery that actually moves markets. I've spent my entire career watching the machinery. 40 years of macro investing. 30 years without a single losing year at Duquesne Capital. I broke the Bank of England with George Soros in 1992 by understanding one thing that everyone else refused to see. The system is always telling you where it's going if you're willing to listen. And right now, in 2026, the Federal Reserve is telling you something. Quietly, methodically. In the language of balance sheets and policy frameworks and carefully chosen words. And if you know how to read it, the message is unmistakably clear. Something bigger is being prepared. Most people missed it. Let me start with December 2025, because that is where this story actually begins, even though almost no one has framed it that way. On December 1st, 2025, the Federal Reserve officially ended quantitative tightening. If you don't know what quantitative tightening is, let me explain it plainly because it matters enormously. Since June 2022, the Fed had been deliberately shrinking its balance sheet. The pile of assets it accumulated during the pandemic by allowing bonds to mature without being replaced. At peak, it was draining roughly $95 billion a month from the financial system. The balance sheet shrank from nearly $9 trillion at its pandemic peak to approximately $6.6 trillion by the time they called it off. 3.5 years. $2.5 trillion drained out of the system. That is what quantitative tightening looks like. And on December 1, 2025, it stopped completely. But here is what the financial press got wrong. And this is the part that matters for what I'm about to tell you. Ending quantitative tightening is not a neutral act. It is not simply pressing a pause button when the Fed stopped QT. It simultaneously began something called reserve management purchases. In plain language, the Fed began buying short, dated Treasury bills again, not to stimulate the economy, not to push down long-term rates, officially framed as a technical adjustment to maintain ample reserves in the banking system. The FOMC's own minutes from December stated precisely that it was appropriate to begin purchasing shorter-term Treasury securities to maintain an ample supply of reserves over time. Note the language carefully. Not to ease financial conditions, not to fight a recession, to maintain ample reserves. And yet, as I have watched for 4 decades, the Federal Reserve's ability to separate its technical operations from its policy direction has never been as clean as they want you to believe. The economic effects of pumping money into the system, lower short-term funding stress, higher liquidity, easier financial conditions, are the same whether you call it quantitative easing or reserve management purchases. The label changes. The math doesn't. Now let's add the second layer, because this is where the picture gets genuinely alarming. Between December 2025 and March 2026, the Federal Reserve's balance sheet went from roughly $6.6 trillion to a position where active expansion was not only underway, but practically inevitable. Consider what the New York Fed's own president, John Williams, said publicly. The adjustment from shrinking the balance sheet back to expanding it was, in his own words, not an exact science, and that the Fed would soon return to a balance sheet expansion phase. That is not a minor bureaucratic statement. That is the president of the New York Fed telling anyone paying attention that the second largest economy in world history is being quietly guided back toward the kind of monetary environment that, in its most aggressive form, we haven't seen since the COVID-era emergency. And he said it with all the drama of someone ordering a sandwich. Now let me tell you what is compounding this problem, because no story about the Fed in 2026 is complete without talking about the world they're operating in. At the March 17-18 Federal Open Market Committee meeting, the Fed held its benchmark interest rate unchanged at 3.5 to 3.75%. Second consecutive hold, the dot plot, which reflects individual Fed members' projections for the future path of rates, still shows just 1/4 point cut in all of 2026 and another one in 2027. That is a razor-thin margin of policy flexibility. But what came out of that meeting that the market initially underplayed, and what I believe is the most important signal of 2026 so far, is this. Jerome Powell stood at that press conference and said he didn't know at least 14 times. He used the phrase wait and see 4 additional times. And when asked directly about the possibility that the Fed's next move might be a rate increase rather than a cut, Powell said, and I want you to hear this clearly, the possibility that our next move might be an increase did come up at the meeting, as it did the last meeting. The vast majority of participants don't see that as their base case. We don't take things off the table. Read that again. The Federal Reserve is now openly discussing the possibility of rate hikes at a time when the official forecast is for cuts. That is not normal. That is a central bank caught between two fires, moving simultaneously in opposite directions at the policy level and the balance sheet level, and hoping nobody notices the contradiction. Let me tell you what those two fires are, because understanding them is everything. The first fire is inflation that refuses to die. The Fed's own updated projections from March 2026 show they expect PCE inflation, their preferred measure, to run at 2.7% this year. That is above their 2% target. It has now been above target for 5 consecutive years. 5 years. Consumer Price Index data through February 2026 shows prices up 2.4% year over year. Core goods prices, which are directly sensitive to tariffs on imports, have been running well above their long-run average since the tariff regime was expanded. And now, layered on top of tariff inflation, you have an energy shock. Oil prices surged as the Iran conflict escalated, with Brent crude topping $109 a barrel during the March meeting week. Near-term inflation expectations, measured by Treasury inflation, protected securities, have been climbing steadily. Chicago Fed President Austin Goolsbee, a man not known for dramatic statements, recently invoked the lessons of 2021 specifically. Policymakers have been burned before by assuming transitory inflation. He said it out loud, in public, because the fear is real. I have been warning about this for years. When the Fed cut rates by 50 basis points in September 2024, I shorted bonds the same day because I thought it was a mistake. I said publicly, and I'll say it again now, that GDP was above trend. Corporate profits were strong, equities were at records, gold was at records, credit spreads were tight. I asked the simple question, where is the restriction? The financial data was telling you monetary policy was not restrictive, and yet the Fed was cutting. I said I hope the Fed was not trapped by forward guidance the way it was in 2021. And here we are, less than 2 years later, with the Fed sitting at 3.5 to 3.75%, inflation still running above target, oil prices spiking due to geopolitical conflict, tariff pressures building in the goods sector, and the Fed simultaneously expanding its balance sheet while telling you rate hikes are not the base case. Does that sound like a central bank that's in control of the situation? Because to me, it sounds like a central bank doing exactly what they did in 1979, right before Paul Volcker had to come in and break the back of inflation with rates at 20%. I'm not saying we're there. I'm saying the pattern deserves your full attention. Here's the second fire, And this is the one that makes the Fed's position genuinely impossible. The U.S. government is borrowing money at a scale that has no precedent in peacetime American history. The federal deficit is running at levels that would have been considered extraordinary a decade ago, but are now simply the baseline assumption for every budget projection. The Treasury is issuing debt on a massive scale to fund that deficit, and the sheer volume of that issuance has been absorbing liquidity from money markets, squeezing bank reserves, pushing repo rates up, and creating the precise stress that triggered the Fed's decision to end QT and begin reserve management purchases. In other words, the Fed is expanding its balance sheet not primarily because the economy is weak, but because the government is borrowing so much money that the plumbing of the financial system keeps threatening to seize up without central bank intervention. The Federal Reserve's balance sheet grew from $800 billion in 2005 to $6.5 trillion by the end of 2025. That is an increase from 6% of GDP to 21% of GDP. 1/5 of the entire American economy is now represented on the Fed's balance sheet. And key analysts, including those at the Federal Reserve Board itself, have quietly acknowledged what every honest macro investor has understood for years. The financial system has become structurally dependent on a massive central bank presence. By ending QT at $6.6 trillion rather than continuing to drain reserves to a much lower level, the Fed tacitly admitted that it cannot withdraw from the market without causing a system-wide liquidity crisis. Think about what that means. Not in abstract policy terms, in real terms. The Fed is the buyer of last resort for U.S. government debt. The Treasury keeps issuing. The Fed keeps absorbing, directly or indirectly. And somewhere at the end of that chain is the value of every dollar in your bank account, every dollar in your retirement account, every dollar your company holds in cash. This is not a conspiracy theory. This is arithmetic. When a central bank's balance sheet represents 21% of GDP and cannot be reduced without triggering funding market crises, the long-term implications for the purchasing power of money are not ambiguous. They are written in every chapter of monetary history, from Weimar Germany to 1970s America to post-bubble Japan. I'm not predicting hyperinflation. I'm saying the trajectory is incompatible with the Fed's stated 2% target, and the people running monetary policy know it. Let me now talk about something that I believe is the most underreported development in this entire Fed story, because it ties directly into the bigger picture that I think is being prepared. Powell's term as Fed chair expires on May 15, 2026. Trump has nominated former Fed Governor Kevin Warsh as his successor. Warsh and Powell represent fundamentally different philosophical approaches to monetary policy. Powell has been determinedly data-dependent, hawkish on inflation, and resistant to political pressure to cut rates, as we saw clearly from Trump's public criticism of Powell throughout 2025 and into 2026. Warsh, by contrast, along with newly appointed Governor Stephen Moran, has argued for a more forward-looking policy approach that anticipates stronger productivity growth from AI and lower inflation, and has favored more aggressive cuts. Moran has been the lone dissenting vote at the last several FOMC meetings, voting to cut each time the majority voted to hold. This transition matters for three specific reasons that I want you to understand clearly. First, the incoming Fed leadership leans toward accommodation, meaning they are philosophically inclined to cut rates rather than hike them, even in the face of elevated inflation. Second, Trump's political pressure on the Fed to lower rates has been relentless and public. He has criticized Powell repeatedly, called for special meetings to ease policy, and has made no secret of his belief that interest rates should be much lower. That political pressure doesn't disappear when Warsh takes over. If anything, it intensifies, because a Warsh-led Fed will have a harder time resisting it. Third, and this is the critical point for macro investors, when you combine a Fed that's already quietly re-expanding its balance sheet with incoming leadership that favors accommodation, with a Treasury issuing debt at record volumes, and with inflation that's already above target and being pressed higher by tariffs and energy shocks, you have a setup that, in my experience, historically ends in one of two ways: either a very painful policy tightening that nobody is politically willing to execute, or a gradual erosion of the Fed's inflation fighting credibility that allows inflation to become semi-permanently embedded in the economic fabric. The 1970s did not happen because Paul Volcker's predecessors were stupid. Arthur Burns was a brilliant economist. He understood inflation perfectly well. What he couldn't do was override the political and institutional pressure to keep money easy, to keep unemployment low, to not be the man who caused a recession. So he tinkered. He made modest adjustments. He raised rates a little, then backed off. He let inflation run a little hot, promising it would come down, and it didn't come down. And each cycle, the embedded inflation rate moved slightly higher, until by 1979, Volcker had to raise rates to 20% and deliberately engineer the worst recession since the Great Depression just to get the genie back in the bottle. I am not saying that is where we are going with certainty. I am saying the setup rhymes. The policy paralysis is similar. The political pressure is similar. The cumulative debt situation is dramatically worse. And the Fed is simultaneously expanding its balance sheet while talking about the possibility of rate hikes. That is not a coherent policy. That is a central bank that has painted itself into a corner. Here is what I think the Fed is actually preparing for. And this is the part of this story that I think deserves the most attention from every serious investor watching this video. I believe the Fed is positioning for a world in which its balance sheet does not meaningfully shrink for the foreseeable future, and in which the interaction between Treasury issuance, reserve management operations, and monetary policy creates a permanent state of what I would call soft financial repression. Soft financial repression means that interest rates are kept low enough relative to actual inflation to make the real cost of government debt negative or near zero. In practical terms, it means that the government borrows at rates that are effectively subsidized by the purchasing power of savings. It means that anyone holding cash or low yield fixed income is slowly losing real wealth. It means that the asset classes that are protected against this erosion, real assets, equities with genuine pricing power, gold, and yes, digital assets with a hard supply ceiling like Bitcoin, perform significantly better over time than anyone modeling them off the last 40 years of relatively stable monetary policy would expect. Now, let me connect this to the 30-year Treasury market, because I think it is the single most important chart in the world right now. And I mean that without exaggeration. Long-term yields have not behaved the way bond bulls expected after the Fed ended QT. The 10-year Treasury yield climbed to around 4.1%, even as the Fed was beginning its reserve management purchases. The 30-year yield has been hovering near 4.88%. Why? Because the primary driver of long-term yields is no longer the Fed's balance sheet operations. It's supply. The U.S. Treasury keeps issuing enormous quantities of long-dated debt, and the market has to absorb that supply at yields high enough to attract buyers. The Fed's technical purchases of short-term T-bills do almost nothing to relieve that supply pressure at the long end. What this means is that you can have short-term rates coming down or holding steady while long-term yields stay elevated or even move higher. That is a steepening yield curve. And a steepening yield curve in this environment is not a sign of economic optimism. It is a sign that the bond market does not fully trust the central bank's ability to keep inflation contained over the long run. I shorted bonds the day the Fed cut 50 basis points in 2024 because I thought it was a mistake. I still think it was a mistake. And I think the combination of everything I've described, the quiet balance sheet expansion, the politically sensitive transition at the Fed, the cumulative inflation above target, the energy shock from Iran, the tariff pressures in goods prices, and the structural dependency of the financial system on central bank intervention creates an environment where long-term bonds remain under pressure for longer than the consensus expects. The consensus on Wall Street right now is that rates come down, inflation resolves itself, and everything normalizes back toward the pre-2020 world. I think that consensus is wrong. And I've been right when consensus was wrong often enough to know that the feeling you get when you're early on a view like this, the isolation, the skepticism, the pressure to conform to what everyone else is saying, is often precisely the feeling that precedes being correct. Let me bring this back to what you should actually do with this information, because I'm not in the business of academic analysis. I'm in the business of identifying where capital should be positioned based on where the world is actually going. I'm not going to give you a specific trade. I'm going to give you a framework. The framework is this: in an environment where the Fed is structurally committed to balance sheet expansion, where the government's debt trajectory makes fiscal austerity politically impossible, where inflation has been above target for 5 years and is now being pressed higher by multiple simultaneous supply shocks, and where the incoming Fed leadership leans accommodative, the assets that perform best are not the assets that performed best in the 40-year bond bull market from 1980 to 2020. That world is over. The assets that perform best are the ones that provide protection against monetary erosion, real assets, companies with genuine pricing power, hard assets with constrained supply. This is not a comfortable view. It is not the view that most financial advisors are selling you, but it is the view that the data, the policy, and the historical precedent all point toward. There's one more thing I want to say, and it's about the Fed itself, because I've been a critic of Federal Reserve communication for a long time. I believe the Fed should not provide forward guidance. I believe central banks should do what the data requires, when the data requires it, without pre-committing to paths that trap them into policy mistakes. Paul Volcker didn't hold press conferences explaining what he was going to do 6 months from now. He looked at the data and he acted. The modern Fed's obsession with transparency and forward guidance has, in my view, repeatedly trapped it into defending positions it should have abandoned months earlier. We saw it in 2021, when forward guidance toward accommodation kept the Fed from responding to inflation for 13 months, while the money supply was growing at 40%. We may be seeing it again now in the opposite direction, where the guidance toward cuts and accommodation creates political and institutional pressure to stay easy even as inflation proves stickier than expected. The Fed's March 2026 dot plot says 1 cut this year and 1 next year. The market is now pricing in no cuts at all in 2026. Those two things cannot both be right. One of them is going to have to give. And in my experience, when the market and the official forecast diverge, the market eventually wins. Here's what I want you to take away from everything I've said. The Federal Reserve in 2026 is navigating one of the most complex monetary environments in modern history. It ended quantitative tightening and quietly began balance sheet expansion, while inflation remained above target. It is holding rates steady while discussing the possibility of rate hikes. Its leadership is transitioning to a more accommodative posture at precisely the moment when inflation pressures from tariffs, energy shocks, and structurally high government borrowing are most acute. Its balance sheet now represents 21% of GDP and cannot be meaningfully reduced without triggering market stress. And none of this is being connected in a coherent way by mainstream financial media, because the mainstream financial media is focused on the wrong things. They're focused on the next press conference, the next data point, the next dot plot. I'm focused on the trajectory. And the trajectory, followed honestly and without the distortion of political optimism or institutional groupthink, points toward a world where the purchasing power of money is under more sustained structural pressure than at any point since the 1970s.